Welcome, everybody, to this quick educational session here from Level Financial Advisors. I'm Mike Hebron, the Chief Operating Officer with Level Financial, and I'm joined today by Apollo Lupescu from Dimensional Fund Advisors. And today we're going to talk a little bit about a hot topic out on the news wires, the debt ceiling, and what a possible not having a debt ceiling in place could mean for investors and retirees. So I think the best place to start on this, Apollo, would be let's just start with a brief definition. What is the debt ceiling issue, and why has it become such a hot topic recently?
All right. Well, first of all, Mike, thank you so much for the invitation to be here, and thanks to all of you for taking the time to watch this. And it is an interesting question because the debt ceiling, it just every once in a while the words pop up, and it's very good to start with the background. Where did this come from, and why is it such a big issue? And to really understand the debt issue, we need to go back to about the early 1900s, actually 1902 to be precise. And at the time, there's this idea to build the Panama Canal. And the U.S., the Treasury at the time, did not have enough money to fund the building of the canal. So what the Treasury did is went to the Congress and asked, can you authorize the Treasury to borrow some money specifically to build the Panama Canal? And then we'll pay it over time because we know that's going to be a good investment. They did that. They authorized it, and that bond issue was specifically for the Panama Canal. So it all started, which is a pretty good idea, that if you need to borrow money, come to Congress. We authorize that project, and then you can borrow the money. The Treasury can borrow the money. Well, it turns out that not long after, World War I started, and when the war started, it became really almost impossible to manage individual authorizations. Well, borrow the money to buy these tanks and borrow the money to buy the ship. So what Congress did is said, okay, no, you don't need to come to us for every particular project, but we will actually give you a cap. So like a credit card limit, that this is the most that he can borrow to finance the war. And it was a pretty high cap. And at the time, I think it was about $5 billion in those dollars back in those days. So it's quite a bit of money. And the Treasury went on and borrowed this money to pay for the war. Now, subsequently after that, as we move along through time, what we see is that the U.S. government is actually spending more, and this is money that is signed by Congress. So Congress approves spending that is greater than what we collect in taxes. And the difference is basically something that we need to borrow as a country. So that's where the debt limit started to come in, because after the war, the debt limit had to be increased. And in fact, over the past 100 years, there have been, actually since World War II, there have been over 100 increases in the debt limit. So the idea is that if you want to borrow money, there's a cap. And when you reach that cap, you have to go, and the Congress has to authorize a bit of a higher cap and a bit of a higher cap. And this has been over and over and over done. So this is nothing unique in terms of raising the debt limit and how much we can borrow. What's been interesting is that over the past, I think about 20 years or so, this has become much more of a political issue. Some members of Congress, they're basically looking at this debt limit as a way to maybe extract some priorities that are important to them. And they say, well, we want to raise the limit unless you give me that. So it became a bit of a political hot potato. And this is not the first time that we got to this point. We had a similar situation in, I think it was 2011. About a year and a half ago, in November of 2021, actually less than that, we had once again a situation we got close to the debt limit, and eventually things got moved up. So it's this idea that having a debt limit to begin with seemed like a good idea about 105 years ago when this was set in place. The only other country that has the debt limit the way we have it is Denmark. And Denmark has such a high cap that they're not even worried about getting there. But we are in this position right now where we have this debt limit. So what happens the day that we reach the debt limit? So that is the maximum that the U.S. can borrow, and it's over $31 trillion. So we're getting to that point. If Congress does not authorize, and I don't think anybody expects that this is never going to happen, but if Congress doesn't get its act together and you get to that point, well, what happens at that point? Well, it turns out that it's a very interesting question because it's never been tested. There's no playbook for that. But think about it just logically. At that point, the government can no longer borrow. And if it spends more than it collects in taxes, well, at that point, it would have to make a choice onto what not to pay, because we just don't have enough money to pay all the bills that were authorized already by Congress. So what do you do then? Well, what's been interesting is that the Treasury has said that any missed payment on anything that the government owes, not just bonds, but you're looking at pensions or military pay, you name it, or Social Security, anything would constitute a default because the U.S. government has not paid its bills, and that would constitute a default. And that, again, that has never happened. So far in the history of the country, we've always paid the bills that were already authorized by Congress. But if we get to that point, again, there are some options. We can talk about those, Mike. But the idea is that it started as a good idea. Just go ahead and you don't need to come with us for every project. We'll increase the limit because as the economy grows, as we have more people in the country, it's kind of natural that this might go up. But it got to the point where it became a political issue, and now people are trying to extract concessions in return for just supporting something that has happened over 100 times since World War II.
Yeah, and my understanding as well is that last Thursday we actually hit the limit.
Correct.
But the Treasury Department has some maneuverability over the next several months where they can move things around to make sure that bills are paid. I think what's on a lot of people's minds, and certainly on the minds of some of our clients who have called and asked, what does this mean for us is, of course, when you have this situation, you have uncertainty. We're venturing into territories that maybe we haven't been in before. So, in that type of environment, what should investors really be thinking about in this type of, it's highly political, and obviously we don't want to get into that, but what are the short-term impacts of something like this, and what could possibly be the long-term impacts of something like this should it, really go all the way?
Right, and it's a very interesting question because, as I said, there is no precedent. You cannot go back and say, well, let's see what happened last time, because this has never happened. So the way that I think about it personally is that you have a lot of scenarios. A lot of things might or might not happen. So there are a lot of things that could happen. And I think that every one of these scenarios, in a way, has a certain probability attached to it. So is there a chance that the U.S. government will default? Absolutely, there's a chance. The question is, how big is that chance? And then is there a chance that at the last minute, the same that's happened before, the Congress will get its act together and actually pass an increase? And is there a chance of that happening? Absolutely. But it's probably a different probability attached to in other words, the odds attached to these different possible outcomes, they're different. So what I encourage people to think is not just, is it possible? Absolutely, it's possible. But how likely is it? And the same with everything in life. I mean, is it possible that something could happen? Yes. How likely is it? I mean, is it possible that it might snow in Los Angeles? Possible. How likely? I don't know. So there are a lot of things that are possible. So then how do you figure out how do you think about this? Well, the way that we look at it as dimensional is that when something like this happens, this is absolutely well known to investors. Investors are not some dummies who are just vacationing on a remote island. They just show up and it's like, well, there's a debt ceiling problem. They know this. And what investors try to do is attach different probabilities to different outcomes. And the way that you see this manifesting is in what we call market prices. In other words, how much is something worth it? And what we find is if there are times when something is risky and there's a chance that you might not get paid, well, that's not going to be worth as much. So what we try to do a lot of times is pay attention to market prices. What is the market telling us in terms of how investors vote with billions and billions of dollars every day in terms of understanding these outcomes and how likely they are to happen? And as of now, what we're seeing is that there is no rush for the exits, that people assign a really high probability to this debt limit not being resolved. In other words, there's a chance, and you can see it in certain prices in the market, just reflecting there is more uncertainty than it was not long ago. Yet over the long term, you're not seeing that people are saying, I'm going to sell these government bonds because they're not going to pay me interest. In fact, what's interesting is if you look at the 10-year treasuries, these are bonds issued by the government that have a maturity of about 10 years. There's something called yield. Yield means, in a sense, in percentages, how much are you going to get paid based on what you pay up front for these. And over the past few weeks, even as this debate has raged, what you saw is that instead of these yields kind of going up, reflecting an increasing risk, you saw them dropping. And it's, again, there are many reasons why they might have dropped, but one thing that's interesting is that if people perceive that something is risky, they would demand a higher compensation. And a really good example of this, Mike, was about a decade ago when the Greek government bonds went on from paying roughly what the U.S. was paying. If you remember the Greek debt crisis, at that point, the Greeks kind of said, well, we're kind of running out of money and we might not be able to pay the bonds. And what happened is the market got a hold of that, and the Greek government bonds went from paying, I think, roughly what the U.S. was getting to paying twice as much almost, or something like that nature. And that was a reflection that the investors were concerned that this is indeed an issue. And if you want me to give you money, you have to compensate me more. And what we're seeing right now, again, is that we don't see that level of panic in interest rates, and the government is still able to borrow at close to historical low rates. You look at a 10-year Treasury yield as of a few days ago, is there about 3.5%. And when you put for the expected inflation that's coming, it's not tremendously high. So long story short, it's not something that we have a precedent. A lot of things can happen, but when you look at market prices, at least at this point, they're not signaling panic. In fact, they're signaling that there is somehow confidence. That's how I read it. That's personally how I read it, is that there is confidence that this will be resolved.
Great. Okay, so anything else? I mean, we want to keep this video brief. So anything else investors might want to think about in the long run when it comes to this, or is really what we're saying here is that the market is sending signals right now that the probability that something like this will happen is probably pretty low, and I'm assuming that that's really what the signals are right now.
At least the way that I read it right now, and this could change, but at least the way I see it right now, that's kind of what I'm reading into it. Now, it's also good to know that a lot of this and what these folks in Congress are saying, well, we're not going to raise the debt limit until we consider some of the spending. And part of this has been fueled by the fact that the U.S. has incurred debt, and the debt is going up and up and up. And I think over the long run, people are concerned, is it possible that the level of debt that the U.S. has might create an unsustainable environment for paying these bonds? And that's a bit of a different issue. But they're trying to link the two. In reality, they're not precisely linked at this moment in time. It's more of a long-term perspective that some of this debt does have to be repaid. And the government does have the ability to borrow new money and pay the old one. So in fact, interestingly, Mike, it's not the level of the debt itself that matters, but it's much more so the how much does it cost us as percent of the overall economy. And to illustrate this, if you look at the early 90s, we didn't have as much debt. In fact, the national debt was a fraction of what it is today. But the interest being so high forced us as a country to spend about 3%, over 3% of the economic output of the country, also called the GDP. We spent over 3% of that in interest payments towards servicing the debt. And what's interesting is that even as the debt has grown and grown and grown and grown since 1990, today the burden of that debt is actually less than it was back in the 90s. Why? Because the interest that we pay on these loans, on these bonds, is a lot lower. And because of that, I think as of 2020 or 2021, last time I checked, the percentage of the economy, of the economic output going to bond payments was roughly about 1.5% or so. And remember, in the 1990s, it was over 3%, so twice as much, even though we didn't have as much debt. So a big consideration here is not just the amount of money that you owe, but how much does it cost you to service that debt as a percentage of the economy? And we actually had higher percentages. So there are a lot of ways that he can cut this. But I did want to say that over the long run, probably one of the issues that has to be addressed in one way or another is the level of debt that comes with spending more money than you bring in. But that's not always the same. And just to kind of reflect on last point, Mike, in the 1990s, the U.S. was collecting so much more in revenue than he was spending, that during the 90s, Alan Greenspan, at the time being the Fed chairman, went out there on record and said one of his concerns is that if we go at this pace, the U.S. government will pay off its debt completely. And if that's the case, and he won't need to borrow any more money, the issue is that you have a lot of investors who have money to invest in government bonds. If the U.S. government, doesn't need to borrow anymore, what's going to happen to all that money? Which is possible they might go to companies, but if you want something really rock solid, well, the U.S. government is still that bedrock of stability when it comes to bonds. So we had a different issue in the 90s. So when you're saying like the debt is unsustainable, again, we went from the early 90s was horrific in terms of how bad it was. And in a short decade, we turned a corner to the point where the concern was that we might not have a debt and we might not issue bonds, which for investors might create a problem.
Absolutely. Absolutely. Okay, good. Well, great stuff. And I certainly appreciate you jumping on real quick on this hot topic because we have been fielding some calls on it. So I guess until next time, I'm Mike Hebron with Level Financial Advisors. That's Apollo Lupescu from Dimensional Fund Advisors. And thanks for tuning in. Appreciate it.
Bye-bye.